Hi everyone, it's Jab out another video, and today I'm going to be talking about FedEx stock, down 22% today. FedEx is typically seen as a barometer of the US economy basically, and a leading indicator for the stock market. Down 22%, and it brought the S&P 500 and the Nasdaq with it. This is basically on some revenue guidance and profit warnings, which is to be expected. Stocks are getting no leeway in this. If you come out with a profit or revenue guidance, you're going to take a minimum 10% hit. FedEx took a 22% hit. That's in addition to what is now 40% year to date, so a miserable year. This only compounds that. Still a reasonable investment. It's increased its dividend a lot. This is the worst day in FedEx's history. It's typically a highly performing stock. Doesn't really move that much. It's a 52-week high of $266 and is right about its 52-week low of $155. It's previously right about in the middle of this range, just doing okay. Pays a nice dividend. And it's typically a very stable stock and a decent long-term investment in my opinion. So I'll analyse what went wrong, what's the profit warning like, what does this mean for the wider market and the US economy, and then look at some balance sheet, profitability, future metrics for FedEx and decide whether I think this is an investable company for the medium term. So FedEx softened the guidance a bit, withdrew its full year guidance, and spoke about implementing cost-cutting measures to contend with soft global shipment volumes as the global economy is significantly worsened in their opinion. Obviously the stock market has took this quite severely. As I mentioned, it's considered a leading indicator of the stock market as well as the broader US economy. They've pointed to weakness in Asia as one of the main reasons for this negative outlook. In sympathy with FedEx, UPS and XPO Logistics dropped almost 5% each. Amazon was down 2% at times. It was down about 5%, I think. This compounds what has been a miserable week for the S&P 500 and Nasdaq, the worst week since June. It doesn't seem like we're getting out of this bear market anytime soon. Even after the decent months of July and August, September has become significantly worse on this news. And it's to be expected, really. I think this drop is probably a little harsh. It's the worst daily drop for FedEx ever. We'll get into the numbers in a minute, but on the surface of this, I think many people will be thinking this represents a decent buying opportunity if you were looking at FedEx. Then profit warnings are one thing, but it doesn't really damage the long-term profile of this business. One of the key statements that the company put out was that they are seeing macroeconomic weakness in Asia and service challenges in Europe, and that has led to a revenue shortfall in this segment of approximately $500 million relative to the forecast. Now, this may seem like an absolutely tremendous amount of money, but you've got to put in mind that FedEx's yearly revenue is in the $90 to $100 billion range. So while this seems like a very large amount, and it is a very large amount, relative to FedEx overall revenue, it's not that ridiculous. FedEx ground revenue was approximately $300 million below company forecast in addition to this, and they've took action basically, rightly or wrongly, to adjust its cost base. Impact of cost actions like volume declines and operating expenses remained high relative to demand, so they've tried to make some changes because they believe that there's going to be global volume declines as macroeconomic trends work against FedEx's business basically. These cost initiatives that they're using to mitigate the reduced demand include deferral of staff hiring, closure of over 90 FedEx office locations, and they're identifying 5 corporate office facilities that will be closed with additional real estate rationalisation plan underway. Just getting their costs under control because they planned for far more demand than they are seeing. And this is probably as a result of an incredibly busy 2020 and 2021. And as the economy cools down, they're just overgeared essentially, so they can doing some consolidation and making some closures and making some cost-cutting measures. Now they believe that with worsening business conditions, weakening even further in the second quarter, they're expecting revenue of $23.5 billion to $24 billion and earnings per share diluted of $2.65 or greater. Now, this is absolutely ridiculous. It's basically flat. They're not going to see any growth. So I'm not absolutely outraged at this by any means. I think this would still represent a decent result in a challenging environment. But I can understand why the stock has gone down. But I cannot understand why it's gone down 20%. That is a bit dramatic in my opinion. They've anticipated capital spending for this year to be revised to $6.3 billion compared to the prior forecast of $6.8 billion. Again, not an absolutely ridiculous decline. In percentage terms, that's less than 10%, so not just a cost-saving measure, but it's not really moving the needle for me. And they've reaffirmed their previously announced plan to repurchase $1.5 billion in sales. The company expects to repurchase $1 billion of FedEx common stock during the second quarter. I would bet that is going to be a lot more now that it is 20% cheaper. So the important thing for me and the important takeaway is that they still see their fiscal year 2025, so that's basically 2024 for the rest of the world. They still see themselves hitting those targets, so they see this very much as a relatively short-term bump and the medium term seems to be okay. This is exactly what you want to see as a potential FedEx shareholder or as a FedEx shareholder, is that the stock looks 20% cheaper, but management think that there is actually no material difference in the medium-term plan. That is exactly what medium to long-term investors want to hear. Take a look at FedEx, the stock. This is a stock that pays out a heavy dividend, buys back shares, doesn't have the best balance sheet in the world. As of the most recent report, it had around $7 billion cash or marketable securities on the balance sheet, about $37 billion in debt. Not ridiculous, but this is getting close to that its market cap value as the market cap comes down quite precipitously. That's a cash set of about 0.2. It's just okay for the industry. This is obviously a very cash intensive industry. They produce a lot of free cash flow that gets invested back into the business at a strong rate, and they spend that cash flow on dividends and on share buybacks. Their interest coverage is reasonable at 10.26, meaning that this year's EBIT, they have 10 years of interest that they could pay off basically. So I'm not overly concerned with the future of this business in terms of possible financial distress. Even with an Altman score of 2.44, I think with the free cash flows this business generates, it's thoroughly fine and an investable balance sheet as it stands, although I would like it to improve going forward. Next, a quick look at some profitability and valuation metrics. From a valuation point of view, pretty much by every metric, this is some of the cheapest FedEx has been in the last 5 or 10 years. PEG ratio of 1.32 is some of the lowest for a company like this I've seen in a long time. I would consider 1 a bargain, under 1 very cheap. 1.32 is just okay valuation, not overpriced by any means, but not an absolute screaming bargain. P ratio 8.72 on a trailing basis and around 6 on a forward basis. Now this may be up in the air because these estimates are not going to be up to the minute, so let's call it a PE of 8 or 9 right now. That is cheaper than the S&P 500 average. This is an above average company in my opinion, with long-term growth trajectory and a quite a big moat in my opinion. This is a solid company and it does not deserve to be trading at a valuation that is that cheap in my opinion. Price free cash flow of around 11. Again, very, very cheap compared to FedEx's historical valuation. I would consider under 15 to be quite reasonably valued. Price free cash flow of 11 for this company is pretty good in my opinion. A price to operating cash flow of under 4 is outrageously lowly valued in my opinion. They convert their gross margin to operating margin and net margin relatively well. The gross margin is not ridiculous because this is a very, very low margin business and it just works off high volume. They have nearly $100 billion in sales, so this business works for them almost like a retail player essentially. 21.5% gross margin, not particularly strong for the industry, but this is an industry with low gross margin, so I'm not going to think it's too much for that. Operating margin just shy of 7% is relatively good conversion here, and a net margin of 4% is again decent conversion. Very asset heavy business, so I'm not expecting an incredible return on assets. Around 4.5 is completely reasonable at the low end of what I would expect for a company of this size and scale, but again, very asset intense business. Return on equity percentage of 15.5 is very, very good in my opinion, very strong for the industry, and just a decent number for FedEx's history. And return on invested capital of 7.5. I think this is pretty good for a company of this size and scale, and I think FedEx is performing reasonably well from these profitability metrics and it's trading at a reasonable valuation, considering that its growth rate has actually been pretty strong, around 9.7, call it 10% over the last 3 years. That's a decent revenue growth rate in my opinion for a company that is valued like this, that is at this size scale and that pays a dividend like it does. Its dividend on a forward basis is expected to be around 3.71%. a payout ratio of around 21%, which is very, very good, and a 5-year growth rate of 11.9%. It's an excellent business from a dividend point of view. A lot of its free cash flow goes towards paying that dividend. And while this company in the recent years has had tremendous stock price growth, that's not always been the case. This was very much a dividend play. The rise of e-commerce and things like that have made companies like FedEx a lot more desirable to own. And you can see by the growth of the stock price in maybe the last 5 years that has been tremendous, and it's more than doubled in the last 5 years for what was previously an incredibly slow-moving company and pretty much a dividend play. Its dividend payout has tripled in the last 7 years or so. That is an excellent number, and stockholders who've held it for that long have been incredibly rewarded. I think they will continue to be rewarded in the near future in terms of dividends. Overall, what do I think of this business? I think it's reasonably valued right now. I think it has long-term tailwinds to grow in the 5 to 10% revenue range over the next 10 years, say. I like this business. I like its free cash flow generation. I like its dividend. I like its ability to buy back shares. Not so keen on the balance sheet, but it's moving in the right direction, albeit very slowly. I kind of like that it's gone down 20%. I think this is a little bit of an overreaction. I think removing the guidance and a slight underperformance on revenue and profit should have perhaps yielded around a 10% drop, but in a very poor week, this yielded a perhaps unfair 20%. 40% off its, well, 40% down the year to date and almost half its 52-week high. I like FedEx at these prices, and I'll be looking very closely to see if it drops any further, because if it was in the 120, 130 range, that would then cross over on my DCF to be in fair valuation. And that will put it in around the $35 billion market cap, which I think would be very, very cheap for this company. And I could see long-term growth being over $100 billion market cap in the next 5 to 10 years quite easily, with a little bit of multiple expansion. Of course, this is just my opinion. You should let me know what you think. Let me know anything you think about FedEx stock. Let me know if you think it's a buy or a sell. Let me know what you think about the current market crash and what is happening with the market this week and how you see this resolving in the near future. Like and subscribe and enjoy the videos. I'll see you again next time.